Thank you very much. And looking out into the audience, it's a great honor to be here. I see a number of extremely well-known people in the industry, and it's a little humbling to stand before you. But I wanted to talk today a bit about stock selection strategies and how to potentially use news in them. And in particular, I've been thinking a lot lately about about portfolio optimization, how to make it faster, what are the pitfalls, when do portfolio optimizers give good results or reasonable results, and can they be made so fast that the speed of an optimization, the speed of portfolio optimization, is no longer any kind of limiting factor? Could they be made fast enough that you could re-optimize 100 times a second with a universe of 3,000 assets? Things like that. So it turns out the answer to that's yes, a bit surprisingly, but. Just a bit of a disclaimer, first of all. The only data I used was academic data and data provided by Ravenpack. I didn't use any data from work, even though we look at similar questions at work, I guess. So I want to start out by presenting an explicit formula for something that you've probably all seen, but it'll be a different explicit formula than the one you've seen. So I wanted to re-examine the most classic thing in quantitative finance, which is Markowitz optimization. This goes back to the early 50s, as you all well know. But something rather special and interesting and unique happens when we join Markowitz optimization together with Ross's APT, also called multifactor models. I call it the standard model of empirical finance because it really seems that everybody uses some variant of that model, and the model is sold by Barra, a different one is sold by Axioma, Northfield. It's in use in every major bank and hedge fund and that trades equities that I know of. Some form of that model is in most academic research, Fama, French, Macbeth, etc. Right? So these are all versions of Ross's APT model, which goes back to 1976. So something rather kind of magical happens when we combine, Ross's APT and Markowitz portfolio selection. So I wanted a formula that was explicit. You could just write it down. It doesn't involve, step 3, send this to an optimizer. I wanted the solution to be numerically stable and obviously well-defined, kind of no matter what you throw at it, right? So, you could have, anybody that's dealt with regression in finance has had to deal with problems like multicollinearity. If you have industries and countries in the same model, then you have the intercept twice, et cetera, right? I wanted sort of one formula that deals with all imaginable such cases elegantly, right? Because, having industries and countries in the model together, it doesn't mean that somehow the optimal portfolio blows up to infinity or something like that. But ordinary regression wouldn't run, so you have to decide what to do. And I wanted something that's kind of scales very well with the number of assets, right? So as I mentioned, if you're interested in running Markowitz optimizations, 100 times a second or more with a few thousand assets, it better be linear time in the number of assets. So, how do you sort of prove? You could claim that some optimizer is linear time and some other one isn't, but I wanted to be able to mathematically prove to myself that that was the case. So, a bit of background. So here's the model that probably all of you have seen because it's the standard model of empirical finance. So some linear functional form, returns over some subsequent period, are driven by a collection of stochastic processes I call F. So these processes are sometimes called factors, or realizations of them are called factor returns. The idea is that there may be thousands of assets in the market, but they're actually driven by a much smaller number of underlying processes. So The epsilons are the residuals to the model, and I will assume that they have a diagonal variance-covariance structure. If they don't, then that probably means we've left something out, right? Because if there were some, if there's something driving the correlations among the residuals, then maybe that should have been in X in the first place, and then the residuals to the new model would be uncorrelated. So, and I mean, this is typically a cross-sectional model, right? So this is, all asset returns for a day, or a month, or some time period of our choosing. I'll suppress the time index because I'm not going to talk much about dynamics specifically. So, that's kind of the notation, right? So the variable is some p-dimensional random vector process, which we can't observe directly. We can try to estimate it, right? I mean, so typically in like a Barra model or something, you would estimate the model using OLS or restricted least squares or something like that, and you would come up with some coefficient estimates. And those are noisy estimates of something that is intrinsically unobservable. So it's important to sort of keep that in mind. Any statement about the F process is a statement about statistical inference. We're inferring something about something that we can't know. I'll assume it has finite first and second moments, mu f and capital F. And then, one of the reasons people like this model so much is that entails a reduction of the first and second moments of the asset returns. In particular, the variance-covariance matrix of asset returns, sigma, becomes diagonal plus this sort of low-rank perturbation of the diagonal. And diagonals plus low-rank is something that numerical analysts typically like, so that should be a clue. So I mean, in these variables, what was Markowitz suggesting that we optimize? Well, so for some risk aversion parameter kappa, he wants us to optimize, expected return. That's h prime times e of r, and e of r in this model is x mu. So that's the first term in equation 5. And then the variance, again, is the sort of low-rank part, x f x prime. And then the diagonal part. And H here is our holdings in dollars. At least that's the units I usually like to represent holdings. So, and the first thing to note is the first two terms only depend on what are typically called the exposures, right? So you probably, especially if you work in a risk department, you've certainly been asked, what are the risk exposures of your portfolio? If you're a quant trader, you've probably also thought about the exposure of your portfolio to various alpha factors, perhaps ones that you designed or someone else designed. So I'll use Q generically to denote both kinds of exposures, risk and alpha. And notice, I haven't specified, right? X here is quite general. So, part of X could be a bunch of alpha factors, part of X could be a bunch of risk factors, or all of one or all of the other, I haven't said. So we want to retain some generality. So in terms of those exposures, the first two terms, can be written quite simply. And this is sometimes referred to as, writing the optimization in factor space. The third term, not so much, right? I mean, the third term, it kind of depends on what the holdings are, which makes sense. I mean, it's idiosyncratic variance, so you're not going to be able to express that in factor space. So that's the term I just explained, idiosyncratic variance. That's the third term. So one interesting thing is that at optimality, the third term can be written as a function of the exposures as well, right? Now, to be clear, this only holds at optimality. I'm not claiming that I can take any portfolio and you tell me it's exposures to risk and alpha factors, and then I tell you it's idiosyncratic variance. That would be crazy. But for an optimal portfolio, you can, because an optimal portfolio, it must minimize idiosyncratic variance among all portfolios with the same set of exposures. So I think that's clear because we already said that the first two terms in Markowitz's function were purely functions of the exposures. So, if the exposures are the same, then portfolio A has lower idiosyncratic variance than portfolio B, it has to be better from the point of view of Markowitz's utility function. So yes, again, at optimality, it's the minimum idiovariance among all portfolios with that exposure, which you could think of as all portfolios satisfying that linear constraint. So you could think of that term on the previous slide as a norm, right? The idiovariance. I mean, D was a diagonal matrix, right? So H prime H would just be basically the L2 norm, right, squared, and H prime DH is some kind of norm of the portfolio. In fact, it's under a change of variables, it is the L2 norm. So not surprisingly, the problem of minimizing a norm has been studied in mathematics quite a long time ago. The minimum norm solution of a linear system is given by some matrix B plus, applied to Q, if the linear system was Bx equals Q. And B plus is called the pseudo-inverse, or sometimes the Moore-Penrose pseudo-inverse after the two major papers about it. Right, and I love pseudo-inverses because every matrix has one. And notice, I didn't say square, I didn't say symmetric, I didn't say positive. I mean, every matrix, any matrix has a Moore-Penrose pseudo-inverse, right? I mean, a 1-by-1 matrix containing the scalar 0 has a Moore-Penrose pseudo-inverse. It's itself. Any matrix of any size containing any elements has a Moore-Penrose pseudo-inverse. And one can actually prove it's unique, but that's a bit of a side point. So the risk and alpha exposures of the Markowitz optimal portfolio can then be written fairly simply in terms of the Moore-Penrose pseudo-inverse. And the way you prove this is just by following through that line of intuition, right? That among all portfolios having some set of exposures, the Markowitz one is the one that minimizes the idiovariance. And when you work out what that actually tells you, it tells you these two equations, 8 and 9. So they're kind of nice in the sense that they not only tell you the optimal portfolio, they tell you its optimal exposures. And in fact, the formula for the optimal portfolio is a linear transformation of the optimal exposures. So the intuition for that is kind of nice. And notice, the dimensions of things, right? I mean, X here, it's typically like, if this were an equity model, it would be stocks by factors. So X would be like, 3,000 by 50 for the US equity market or something like that, right? So then, X prime D inverse X is 50 by 50. F is the factor covariance matrix. It's 50 by 50. And you typically have plenty of data to estimate a matrix that size. I mean, I think, the fundamental problem with modeling equity covariances, right, is that, you never have enough data. The sample covariance matrix for equities is always mostly noise because, there's just never, even if you go back 20 years or something, you have only a few parameters only a few data points per parameter. So, I mean, you need some kind of dimension reduction to make any sense of a covariance matrix in the equity market. So this is sort of, then once you have that dimension reduction, what is first of all, I should expect to be able to optimize a lot better than if I didn't have a dimensional reduction. And then, this is sort of, this is what the optimal portfolio is. So we wanted it to be linear time in the number of assets. So, that's actually not hard to prove. Going back and dusting off the old Golub and Van Loan linear algebra, matrix algebra computation book from your shelf, you find that, you can compute at least enough of a singular value decomposition as you need to get the Moore-Penrose pseudo-inverse and the actual inverse in 6n p squared plus 20 p cubed flops, floating point operations, right? So, remember n is the number of assets, p is the number of factors. Typically, right, if you're talking about larger and larger portfolios, n's getting big, the number of factors isn't necessarily getting much bigger. So, I tend to think of P as sort of a constant, right? Like, because for example, in the U.S. equity market, you might think there's about 10 so-called style factors like beta, vol, momentum, value, foreign currency sensitivity, and 6 or 7 other things of that ilk, plus maybe 24 industry groups or something. So you end up with something like 50 factor. I tend to think of that 50 as like a constant. And then, but n is thousands. So I tried this out. I have an old MacBook Air I bought about 5-6 years ago, and I did an empirical study which we're about to talk about, and it had about 2,500 assets in it because the U.S. equity market. I started with the Russell 3000, and the bottom 500. That's pretty illiquid, so it really just took a few milliseconds. Which is even better than I was hoping for, really. I mean, I was thinking it might take, a fraction of a second, but it was more like, 8 milliseconds or something, which is pretty nice. Here's the code I used to do it, and I'm also, I'm kind of fighting maybe the prejudice some people have that, Java isn't good for linear algebra, or the Java code is very verbose. I mean, I wrote the same thing in R. It was actually longer because, because R wasn't particularly type safe. I had to do some manipulation on the matrix labels and stuff, whereas Java took care of all that for me. In full disclosure, I used a package called JBLAS, which basically imports into Java the same super fast linear algebra routines that you have in MATLAB and R and NumPy and everything. So for anybody that hasn't checked out that package, I recommend it. It's pretty cool. So Markowitz optimization, some of the classic objections were like, well, it's unstable. It depends sensitively on the inputs. Where are you going to get a 3,000 dimensional covariance matrix anyway? It's slow. It takes seconds to run. I'm kind of slowly tearing down some of those classic misconceptions. And I mean, honestly, Steve Ross is really the one that tore them down, because as soon as you have APT, all the kind of problems with Markowitz optimization go away. And if I think also, like, I look back historically, some of the kind of people that have said, there are serious problems with Markowitz optimization, or you have to do something different. In many cases, it seems like they were looking at, portfolios with 20 assets that were rebalanced quarterly or something like that. So there, I think the problem is the expected returns are essentially noise. And you'd have to look over, a few centuries or something to see the statistical significance kind of emerge in, 20 assets and quarterly returns. So, for any kind of statistical significance, you have to have enough data to sort of see it emerge. So I mean, in the study I was doing, again, we have the U.S. equity market, 2,500 assets daily. So, you can see if something's significant, you have a better chance of seeing it. A few remarks on this formulation. So, we don't assume X is full rank, which is convenient. Or for that matter, that, D, I think it's, the square root of D times X is what we would really, if that weren't full rank, then the optimizer would blow up, a classic one. This formulation doesn't assume that, right? So it's one of the nice things about, let's say you have, let's say you had a factor model where you have, countries and industries represented as dummy variables. Each set sums to an intercept. So the model is unidentifiable, right? And there are other kinds of unidentifiable models. So let's say that you had a factor model that had value and momentum in it, and then you have an alpha signal that's, some combination of value and momentum. Well, okay, fine. That isn't identifiable either. It doesn't mean that the model formula, as we wrote it down on like the second slide, can't be true. I mean, the model formula says that returns are driven by some combination of unobservable processes. It doesn't. I mean, and that can still be true if some of the unobservable processes happen to be linear combinations of the other ones. It can still be true that some combination of them drives returns. It's just that classic statistical inference doesn't really. It doesn't suffice to fully tell you information about the unobservable processes. You have to have some sort of prior, or use something other than classic linear regression. The Moore-Penrose pseudo-inverse is one solution to that, right? Because it's explicitly the minimum norm solution to a linear system when there are many solutions. So, in these unidentifiable regression models, with countries and industries and alphas that are spanned by the risk factors and whatnot, that's what you have, right? I mean, there's sort of many solutions to the regression problem. The least squares problem is the objective function is very flat. It's completely flat along some direction, and so you need basically another term in your objective function. So the Moore-Penrose pseudo-inverse is like saying, okay, let's add another term that says that we want the solution to be small, have small norm. And that's just like having a prior on the solution as well. And I mean, the equations remain valid if there aren't any collinearities. They're completely general. It's just like, if you had an invertible matrix, the Moore-Penrose pseudo-inverse is then just the regular inverse. It's just that you don't have to have an invertible matrix. Sensitivity to parameters. That's something that's talked about a lot in Markowitz optimization. And the main source of sensitivity to parameters here is to, if you had some asset that supposedly had really small vol, right? Because then it would tell you to have a huge weight in that asset. I personally don't believe that there are these assets with, at least in a forward-looking sense, have really small vol. Or if there are, maybe they're things you should have excluded from your universe. So if you have, if you're doing an equity model and you have like cash as one of the assets, okay, fine. But it was supposed to be an equity model. Once you've defined your universe appropriately, then I don't really believe there are like common stock of liquidly traded companies that in a forward-looking sense, we should think they're going to have, volatility of a fraction of a basis point per year or something, right? I mean, nobody would believe that. And so it shouldn't be the case that we come up with a predictive model for volatility that says, that allows it to be tiny. So the way I deal with that is I have a strong prior on the idiosyncratic variances, and then I use the posterior variance. There are other. I mean, some people just cap the floor the variance or something at some minimum allowed value. Either way, then then it turns out it's not really so sensitive anymore. I mean, your portfolio will have lesser weight in the really high vol assets, but that's probably what you wanted. As I've hinted at, right? So the intended application is to cases where we have some number of alpha models as, let's say, by convention, those are the first m columns in our matrix, our design matrix, and then some number of risk factors, which are the remaining k columns. This is kind of an interesting point. People sometimes talk about factor neutral portfolios or factor neutral investing. There are funds that are marketed as market neutral funds. So on and so forth. So, I mean, how do you get that? And, is it optimal? Would you want that? So, I mean, it turns out there is a portfolio that's neutral to all the risk factors, x sigma. And if you took the block of the factor covariance matrix corresponding to the risk factors and then just kind of take the limit as their vols go to infinity, the optimizer will naturally say, I don't want any exposures to those things. It's going to cost me like crazy in vols. So, in the limit, you'll kind of get what you would have gotten if you had simply constrained those factor exposures to 0 exactly. However, note the trick we had to do to get that. We had to take a limit as certain parameters in our model go to infinity. In reality, those parameters have finite values. So, if you're doing this form of like exact projection onto factor neutrality, then you should know you're not on the efficient frontier. Trading cost. So all this was, Markowitz optimization is great, but what about, in the real world, there are trading costs, there are turnover limits, things like that. The only thing I have to say about that within still within the framework of things that can be solved in linear time in 8 milliseconds on my old laptop is that if we have quadratic trading, we have a quadratic model for trading costs, right? So the model is, there's some diagonal matrix lambda, and then our trading cost is basically, lambda times the square of the trade size. then, unsurprisingly, it's just one more, diagonal quadratic term, just like the idiovariance term we already had. So, unsurprisingly, the mathematical structure of the problem is the same. So I submit that, trivially, that problem can also be solved in 8 milliseconds on my old laptop. And this trading cost model, I don't use it in practice, and I'm not a huge fan of quadratic trading cost models, mainly because they kind of say small trades are free, large trades are really, really expensive to the point that you would never do them. So I have mixed feelings. I mean, I think it might be useful as a research tool, right? If you're wondering, is this model going to completely go away if I put in trading costs? Playing around with the lambda matrix here might tell you that. And at least you can do that in seconds now and not hours or weeks, or I don't know how long it used to take. So let's try this out in practice. And I was thinking of all the many ways that the Ravenpack data feed can be used, because there's so much structure there, right? There's 2,000 news categories. We saw some of them in Peter's talk. I didn't want to just do the same thing Peter was doing, so I didn't look at the earnings category. So I was reminded of a paper by Lakonishok and Lee in 2001. Are insider trades informative, right? So, as you all know, top officers, directors, large shareholders, et cetera, have to report their transactions. Lakonishok and Lee themselves quote this old note from something called Individual Investor magazine. I didn't know that was a magazine, but they say, company executives and directors know their business more intimately than any analyst could. They know when products are selling well, whether profit margins are expanding, et cetera, right? You always hear about the smart money. Generally, that's the smart money. In the same sense, open market share repurchase programs are similar, right? They represent insiders' views, maybe not with their own money, but with also something they care about, which is, shareholder equity. So either way, it's, people who know, who have access to the next year's earnings before they come out, expressing a view of some sort publicly. So I decided to test this idea using data from CRISP and Compustat, which I was able to obtain thanks to my affiliation with NYU, and then Ravenpack was kind enough to also provide me a kind of an academic subscription through NYU. And I mean, among the many news categories in Ravenpack, one of them is actually several of them concern these insider transactions, open market share buybacks, things like that, right? As they're reported in the news, they're categorized in the Ravenpack feed. So I took 2,500 large cap US equities, excluding closed-end funds, REITs, ETFs, unit trusts, et cetera. Anybody that's ever worked with CRISP, it's the first stage is just kind of figuring out how to actually get equities out of it. So that took some time, but I did eventually solve that. So then, as a risk model, I built a simple, market data, kind of 12-month to 1-month momentum, some transformation of market cap for like a size factor, a vol factor, and then the 24 GICS industry groups, just 1-0 indicator variables. I didn't have to worry about countries, obviously, since it's the US. The resulting strategy that comes out of this will be a long-short model. We haven't set any sort of long-only constraint or anything anywhere. And moreover, I mean, it has to be long-short because the industry factors add to an intercept. So, I mean, and they're pure risk. So any optimizer without being constrained will tend towards dollar-neutral portfolios. And I mean, I also have cap M beta in there, which is almost always positive, right? So if I also want to be approximately neutral to that, and again, it won't be exactly neutral for the reasons we mentioned, but approximately neutral in proportion to the risk that it represents, right? So cap M beta is also positive and averages 1, so that'll also tend us towards long-short portfolios. So we want to be neutral to that. It's hard to find, assets to go long that are beta hedges. Our alpha model is just an indicator of whether there has been any insider buy or share repurchase programs in some trailing window. So nothing rocket science there in the definition of the alpha. And in fact, I wanted to stay true to the original paper. Lakonishok and Lee don't claim that there's some rocket science machine learning transformation of this information that's necessary. So I didn't do one either. And I snap the information as of the market open, and then basically look at close-to-close returns. That's a kind of a standard technique for quant traders because you have to basically assume there's if you were going to trade into a position that there's sufficient time. So it's kind of an entire trading day basically. And this is what I got. So this is from 2002 to the end of 2013. Has a Sharpe ratio of about 1.4. Annualized return of 2.5% across book, and these are cumulative returns on cross book. So that's impressive. I mean of course with any kind of trading cost, these returns wouldn't be achievable, right? And there aren't that many hedge funds that have Sharpe ratios of 1.4. If you ever look at the HSBC report, you'll see that. So, I mean, I'm not claiming that that this would be achievable. However, it is kind of indicative, right? I mean, if there weren't some statistically significant, information contained in these insider activities, then you wouldn't see this, right? I mean, the t-stat on the test that the mean of this is 0, the t-stat is 10 or something like that, 9, I don't know. But there's no way you get this from a mean 0 Gaussian process. So, could you achieve this? I mean, there are funds that try. There are funds based solely on this idea of, let's find small cap value stocks and where the insiders are buying back things. I mean, the cases I looked at, it looked like their returns were kind of identical to like a small cap value index. So I don't know if there's any true success stories. I mean, it seems like from this that you ought to be able to beat a small cap value index by at least something, but And I mean, I guess, to deal with the trading cost, I mean, this is a fairly slow-moving signal, but to deal with the trading cost issue, of course, if you had other signals, you could try to time your entry into these things using other data, such as, maybe what Peter talked about. So thanks a lot for the invitation to be here. It's an honor. Thanks to Armando and Ravenpack. That's it.
So we have time for a few questions. Got one over there, 2.
I mean, you showed a model that was trading daily, right?
Yeah.
What was the turnover like? Granted, we already discussed how we don't believe that transaction cost.
Yeah. I mean, I don't, I didn't do sort of like a full quantitative analysis of the model because that would have taken 10 slides and so forth. And I mean, the idea isn't so much like, oh, here's a great model for you all to go trade. The idea was, I wanted to kind of showcase this great research tool that we now have where we can do a Markowitz optimization in 8 milliseconds. And so, we can very quickly and easily, at least tell if there's maybe something there that's suitable for future research. I mean, with that said, the way I constructed the signal, I was looking at sort of at least a multi-week, trailing window. So this isn't some sort of signal that's turning over daily.
Did it keep working past 2012 or 2013, or do you see similar results, or you didn't look past that?
Yeah, I mean, somehow the data files I downloaded ended in 2013. I mean, but anecdotally, from other things I've seen, I don't think there's any great difference in performance in the last 2 years. I mean, but I was kind of thinking of this as an academic study, and academic studies usually, they don't go to great effort to make their data run through yesterday or something. But no, I don't think it's died, since the end of the study or anything like that. And I mean, you wouldn't necessarily think, right? I mean, if you know, I mean, if there's information, you know, if there's always been information in, you know, this informational asymmetry between company insiders and the rest of us, which makes perfect sense that there would be, we know there's an informational asymmetry there, you know, and there has been for forever. I don't know why I think it would have just suddenly died now. I mean, you'd have to tell a story like, well, this idea has become so widely known and there are so many quantitative traders trading on it that, you know, the information just gets priced in instantaneously. But it didn't in 2013 anyway, and most of the quantitative traders I know now were also around then, so.
So I was wondering, how would it be equally easy to include higher moments in the optimization function like skewness and kurtosis?
Well, I don't think it would be that easy. You know, I mean, definitely in my derivation of the super fast explicit formula for the Markowitz portfolio, I took advantage of the quadratic structure. And I mean, for that matter, right? I don't actually know of anybody in practice who's kind of really successfully implemented this sort of optimizer with higher moments idea. I mean, I think it's one of those things that kind of sounds good on paper, but when you actually try it, it's like you start to realize, you know, we don't really have that much data to estimate the third moment anyway, and you know, and I mean, you know, if you're trading 5,000 assets, your actual, you know, portfolio return ends up being pretty Gaussian, except for August '07, and you know, and that wasn't, August '07 wouldn't have been predictable from looking at the fourth moment of anything. So, yeah, I think that kind of higher moment stuff isn't really the holy grail that people might have dreamed that it was.
Hi, I had a question on the Lakonishok and Lee study that you did. What was the time frame of your returns?
Well, I mean, for me, I just constructed a portfolio every day. You know, but with a fairly slow-moving signal, right? So, I mean, that has a kind of a deterministic mathematical relationship with a hypothetical related study that would look at returns over some long horizon, right? I mean, if you have something that doesn't change and you look at it over daily returns for a month, that's kind of like snapping it at the beginning of the month and then looking at it over the month return. You know, with that said, I mean, I think you know, classically, academic studies didn't necessarily have access to the kind of great data we have now. Like, you know, Ravenpack data is millisecond timestamped, you know, and the data begins in 2000. So, I mean, Lakonishok and Lee, had Ravenpack been around, would have only had access to a year of the data anyway. So, I mean, you know, I could benefit because, you know, I could sort of construct a proper backtest with sort of correct millisecond timestamps. Typically, academics have shied away from that kind of thing because a lot of times the data sets they have access to are you know, at best daily, and you know, they're very cognizant of, you know, picking up some sort of bid-ask bounce or whatever in daily close prices. So, you know, they typically look at monthly or quarterly data. I'm used to looking at somewhat higher frequency data than your typical, you know, typical academic, I guess, because I do it for a living.
No, but in this case, I mean, once you take a trade, would you be keeping it for, you know, a month, a quarter, or?
Well,
on this study.
Yeah, so in this study, I just formed the Markowitz portfolio daily. And then I value that using I value the P&L using daily returns. So there isn't some explicit, you know, system to say, you've entered a trade, you know, then there's some other signal to exit the trade.
Okay. Well, I had a question because in the paper itself, I mean, they usually say that it's predictive over, you know, generally long term. Like, I think in the paper actually talks about 12-month period.
Yeah.
So did you look at that as well?
Well, you know, I think it may very well be predictive over a longer horizon with a lower Sharpe ratio. But as I mentioned, there's a deterministic relationship between, you know, like a 12-month return is the sum of 252 daily returns, and you know, so I mean, and if you're, there's also the question of how frequently your data changes. And so if your data is, sort of like autocorrelation horizon of a year, and then you're looking at yearly returns, you could slice up the data and slice up the yearly returns and make it into a daily study if you wanted to. That's just a mathematical transformation.
Okay,
We have,
thanks.
we have time for just one more question.
Yeah, hi. In your last example of trading strategy, in your last example of trading strategy, you showed a Sharpe ratio of 4.
1.4.
1.4, sorry. We were actually buying stocks that were basically going through a buyback. And you also said that it was similar to a value strategy. It wasn't very different from value strategy. So is there really, did you see the overlap in stocks between the value strategy and the companies that were actually going out and buying the shares?
Yeah, I mean, so I should clarify a few things about what I did and what other people have done in the space. I mean, I was actually I actually didn't take into account value exactly, right? And the Markowitz portfolios that I constructed would have been essentially long companies that had this sort of potential insider activity or open market share repurchases, and then also short a bunch of other companies in order to hedge the beta, the momentum, the vol factor, industry exposure, right? So it ends up being very much a long short kind of dollar neutral portfolio that I'm talking about. Now, I mean, one very interesting thing that's been talked about is could we use the notion of some notion of fundamental value, like some sort of fundamental price ratios, to further improve this idea, right? So, for example, maybe if a company is sort of beaten down and has a sort of like a very low multiple, and the directors are buying it, then that might be an even stronger signal. So there's a statistical model for that too. It's not the one I did, but I mean we could come up with a model that we regress returns on an interaction between the buyback factor and a value factor, and see, and if that interaction is significant, then we could further refine our optimizers, right? I think no, but like I searched Bloomberg for funds that seem to be trading on this idea. The ones I found, I couldn't actually see alpha over the CRISP small cap value index, which I found a little perplexing because it seemed to me that there was something significant there. But that would be a topic for future research, I guess.
If you were looking at the announcement dates, and that information might have already been priced in the stock, until you look at some factors like cash balance and something else, where the information is not priced, because at times, given the value of whatever factor you might look at, if we just go by the announcement date, that's already priced in the market. So it won't give you any alpha, it won't give you any abnormal returns.
Yeah, well, but that's not what I found. I mean, I found that it's not fully priced. It's sort of mostly priced, but there are still these optimized portfolios you can build that have a Sharpe ratio of 1.4, at least before trading costs, which means that something about it is not fully priced. Now, I mean, as for the announcement date or any other date, I just used the millisecond timestamp that was in the news, right? So whether it was the announcement date or not, the only question I looked at is whether Ravenpack's newsfeed has reported it yet. So I mean, I don't think there's any sort of look-ahead bias, and I think that if there are a lot of quantitative traders in the room, I mean, we all know that a lot of things we look at are sort of mostly priced in, but not quite. I mean, a lot of quantitative trading models predict 5 or 10 basis points of return per day, which means that if you're kind of sitting there looking at the price on your Bloomberg machine, you don't go oh, that's clearly wrong by 5 basis points, but.
Great. Gordon, thank you very much.